Welcome to the Real Estate and Wealth Podcast, your go-to resource for navigating the world of real estate investing and wealth creation. This podcast is brought to you by Calvert Home Mortgage Investment Corporation, your trusted, caring, and responsive short-term mortgage lender in Alberta and Ontario. We explore strategic and tactical solutions to elevate your real estate portfolio, drawing insights from seasoned Canadian investors and trusted advisors. In each episode, we dive into various aspects of real estate investing, including market trends, property analysis, financing strategies, risk management, and much more. Whether you're a seasoned real estate investor looking to expand your portfolio or a beginner taking those first steps, this podcast is for you. Perfect. So today on the podcast, we have Kim Moody. I know, Kim, you have quite the extensive background. I'll let you introduce yourself. Tell us what you have on the go and a little bit about yourself.
Well, I'm 5'4" on a good day. Yeah, that's about it.
Mom is short and sweet.
So I'm a tax guy. I'm an accountant by profession. Started a tax law firm, Moody's Tax. A lot of years ago already, and an accounting firm. And the first question I get is, "Well, you're an accountant, not a lawyer. Did you start a law firm?" Yeah, I did. And so grew the offices to Edmonton, Calgary, Toronto. We practice in cross-border tax in Canada, US, and the accounting firm cross-border filings and reportings, and we restrict our practice to private clients, high net worth, ultra high net worth clients. We don't do any public company work. Not that we couldn't. It's just that we don't like that space. We just want to, provide a quality service to private clients. And then I stepped down from the leadership of the firm last year. I'm still with the firm, but it's under, my partner's leadership now. So I spend a good chunk of the time with the firm, a good chunk of the time causing trouble, writing pieces in the Financial Post and giving it hard to the government. And I do a podcast myself, actually. And what else do I do? Private consulting, public speaking, just a bunch of shit. So am I allowed to say that?
You're allowed to say that.
Okay.
Yeah.
So that's me in a nutshell.
Yeah. Thanks for that. And thanks for being here. And to our audience, we view Kim and his firm as some of the preeminent tax experts in Canada. When we got in, where Kim is never short on opinion and expertise. Nope. So, thinking through who our listeners and viewers are, real estate investors, people who built wealth through real estate, people who are managing wealth, and there's a lot of great topics du jour. The 3 or 4 that we landed on talking about today is short-term rental, capital gains.
Yeah.
With the release of the budget, I think that's on everybody's mind, and how that impacts. Again, we'll mostly focus on the real estate investor, the homeowner, the principal residence exemption interpretation. As it relates to capital gains, and then the flipping tax from both the federal perspective and something new that BC is doing is I'll call it layering on, for lack of a better term for now. But sure. Those are the topics. So let's get into start with short-term rental, Kim.
Sure.
What do you see in there?
I got lots to say on that. Let me just say that I wrote about this in my Financial Post pieces. I'm a weekly columnist for the Financial Post, tax columnist. And last fall, when there were some rumors floating around that the government wanted to go after short-term rentals, it was just part of the ongoing, what I call boogeyman. Let's go after the boogeyman, mm-hmm. Right? Canada has a housing challenge. Which I'll just pause there for a second. I think you and I, Ryan, are roughly the same age. Jesse, sorry. Ryan, yeah. Jesse, Jesus, I'm so bad with names. Okay. I'm going to call you Bob. So Bob and Dick, okay? Just so I don't.
Yeah, Ryan's about 10 years my junior.
Yeah, exactly. So I think you and I are roughly the same age. I'm guessing.
Yeah, 42.
So, yeah, shut up. So I'm 56 this year, so maybe you're a hell of a lot younger than me. But I remember as a youngster. And I came across some CBC National, when actually CBC had some decent content. And there was a clip that I was watching recently on Canada's housing challenges. And so, housing challenges are always a challenge for any country, including Canada. And historically, we've always had a problem. Recent challenges, though, in my view, are very self-inflicted, and it starts with high immigration and unchecked immigration. And even to say that, you know, even a year ago, I mean, if someone was brave enough to say, hey, we got too high immigration levels, you're labeled something.
Tell us about the policy and the strategy on immigration. Like even that is opening up a Pandora's box.
It completely is. And, I had a nice chat with, some people that are very connected politically. Even Jason Kenney is very, he used to be the federal minister on immigration during his time in federal politics. And he's been pretty vocal about, how Canada needs to get the immigration levels checked. And so I don't think it doesn't take a rocket scientist to understand that a lot of our recent challenges have been because of unchecked immigration. But back to tax for a second, in the boogeyman, let's not deal with the real issue, which is, unchecked immigration. Let's deal with these damn short-term rental owners, who are, not putting long-term rentals into the pool. Or let's pick on flippers, which we'll talk about. That's another boogeyman.
Yeah.
And let's pick on, and just the list goes on, right? And actually, the other one that's so obvious I forgot about was foreign owners of residential real estate.
Mm-hmm.
You can't have foreigners, buying Canadian residential real estate because they're the ones that are causing all the problems. And so we have this underutilized housing tax, targeted at foreign owners, and we have bans on ownership of residential real estate, which was set to expire at the end of this year, 24. But in their infinite wisdom, they've extended it another 2 years, which is ridiculous. And so when you understand what's going on, picking on boogeymen, you'll understand how ridiculous some of the tax measures associated with that is. So let's go to short-term rentals. Apparently short-term rental owners are really evil, apparently, because they're sucking up all the real estate. And in my view, what they've done is nothing short of just pandering to their voting base, which is, people that I call them NIMBYs, not in my backyard, right? Mm-hmm. And I used to sit on a strata council for a property I owned in British Columbia, in Invermere, British Columbia. Love that area, and I now have a hobby farm there.
I have a place in Radium, and
oh, do you?
We probably have encountered the exact same NIMBYism.
It's unbelievable, So I was the treasurer of this strata council, and the people that are in the strata council, they're very good people, and they mean well, but they just can't see the forest for the trees in many cases, right? It's public policy. What's that? I just want to make sure my house is that I'm not bothered by these evil neighbors who come in on a short-term basis. How silly, right? I mean, it has nothing to do with property rights and democracy and freedom. It has to do with me, and I call them NIMBY people. So the government introduced rules, which the draft legislation was released earlier this year, that if you're a short-term rental owner or operator in a municipality like my strata that prohibits short-term rentals, then all expenses are denied against the taxability of that income. So let me put that in perspective a little bit. And I've written about this a lot and publicly spoken on it. So Jesse, let's say you're a drug dealer.
Mm-hmm.
Okay. So you're just a bad dude. You're a criminal. You're selling cocaine. And you've got quite the little dealer network going. And so, Ryan is one of your dealers, and you've got a bunch of expenses, and, you got some automotive and gas and, whatever expenses you got going. So first of all, what you're doing as selling cocaine is criminal, right? That's a criminal act.
Yeah.
You can end up in jail for that. But you are smart enough to understand that if you don't report your income, that's tax evasion. That's another criminal act. And so you come to me and you say, you know what, Moody, I know I've got one criminal act. I don't want to be a double criminal act because I'm probably going to end up in jail twice or longer. So I want to report my income. And so I give you some advice on that, and I help you file your tax return. and I get all your expenses together, and we pay tax, or you end up paying tax, sorry, on 10,000 minus all of your expenses. So let's say your expenses are $8,000.
Right.
Okay, so 10 minus 8 is 2. You're going to pay tax on $2,000 rather than 10.
Yeah.
And is there any prohibition in the Income Tax Act against the deduction of those expenses? And the short answer is no, there is not. It's any reasonable expenses that are incurred to earn business income are deductible.
Mm-hmm.
And as much as you may not like that it's for the person that's living or listening to this, that is still business income, even though it's criminal.
Right.
Now let's go to this proposal. Now you're a legitimate dude. Okay, you're a short-term rental owner in Radium,
mm-hmm.
and your strata that you're in says in the bylaws that nope, you can't have short-term rentals, but you go ahead and do it anyhow. And the reason why you do it is because you need to make a living, and you're prepared to pay the fine if they catch you, because the fines typically are not that much. And so, okay, fine.
Nor are they illegal.
Exactly. So in any event, so now with this federal law, all the expenses associated with that are non-deductible. So you earn 10,000, just like when you were a bad dude selling cocaine.
Mm-hmm.
Now that $10,000 is taxable. You have the same 8,000 of expenses. Let's say it's insurance and repairs and maintenance and property taxes and what have you. Do you think you paid tax on your net of 2,000 or 10?
In this instance, we're paying on the whole 10.
You're paying on the whole 10, right? That's the result of this rule. So if you see how silly this is and how dangerous it is from a public policy perspective, so you as the drug dealer are apparently a better person from a public perspective than the short-term rental owner. And when they create laws, it's all about trying to create behavior and incentivize behaviors, right?
Mm-hmm.
So, of course, this is trying to incentivize no short-term rentals. But what about drug dealers? Are you telling me from a public policy perspective that they're better? Now, the easy rebuttal is against my crazy example is that most drug dealers are not going to report their income. Right. But it doesn't matter. My example is still sound, right? And so it is extremely dangerous, this proposal. The NIMBYs that are out there love this thing. Oh, great. Yeah, right. Do you think this is good from a public policy perspective? It's silly. Will it solve Canada's housing challenges? Not even close. I mean, there is no statistics that I have seen, and maybe you guys, because you're in the residential real estate business, or real estate business period, maybe you got some statistics, but I've seen no credible statistics that say that short-term rental owners are making a significant negative contribution to Canada's housing challenges. I had one guy respond to me saying, well, Kim, you don't need statistics. It's just common sense.
Right.
What common sense? You're telling me it's common sense that short-term rental owners are causing Canada's housing challenges? Well, you better explain that common sense to me, because I think I'm a sharp guy. I don't get it.
Right.
So in any event, there you go. That's my little rant on short-term rentals.
So that's on short-term rentals.
Yeah. Like, how silly is that? Right?
And again, from a more holistic standpoint, the policymakers are finding these boogeymen.
Yeah.
In an effort to appease the populace.
Oh, just their voter base. This is all about votes, right?
Right.
It's politics. It's not good tax policy.
And what we're trying to do, with I hope, are twofold. Solve the housing crisis.
Yeah. I hate the word crisis. It's a challenge, by the way. It's not
a
crisis.
Challenge. Yeah. So solve the housing challenge. Where the demand far outstrips supply today.
Yep.
Immigration has a big piece of it. I think lack of forward thinking with good policy to incentivize the behaviors of building, construction, development, those entrepreneurial endeavors that now these boogeymen being real estate investors, whether they be short term, whether they be people are the bulk of our clients who are buying underutilized housing stock, in a lot of instances creating additional and putting it back to the market, to me, all the while doing something productive for our economy, which is another issue that we'll get into on another day as it relates to Canada's productivity and lack thereof, which is going to be a major drain on us for the foreseeable future. But we're trying to solve this housing shortage.
I like that word better, yes.
We're trying to solve this housing shortage. And short-term rentals, one idea that they think they're going to help with it, but we've not seen any data. I haven't seen any data in that limiting short-term rentals.
I think the short term is there is no credible data out there. Like, give me a break.
Yeah.
This is all boogeyman crap.
Is going to bring supply to the market.
Yeah.
Have you seen anything from that?
No.
Okay.
Yeah, I think to the guy that criticized me one time and saying, "Hey, it's common sense." Hey, the one thing I certainly will say is there's no doubt that some short-term rental owners who are not in compliance with their municipal bylaws will get spooked by this if they understand, the devastating impact of it. But one thing I said in the Financial Post is what's the behavior change that's going to result from this? If you have, yourself that wants to be compliant with tax law, but all of a sudden realizes, holy shit, I got to pay tax on the gross income. What are you going to do with that? Are you actually going to pay tax on the gross income? Or are you going to be like the typical drug dealer and not report it?
Right.
And what I've said in the Financial Post is I think there's going to be a good chunk of the population that just won't report it.
Well, if you pay tax on the whole, in all likelihood, you're losing.
Of course.
So why are you even bothering?
So I think what's going to happen is, to this common sense, in retort to that, I think for people that continue to short-term rent in non-compliance with their bylaws or municipal bylaws, they'll either not report the income or they'll get the reaction that the government wants, apparently, which is to throw it into a long-term rental vehicle.
Right.
So I think there'll be a disproportionate amount of people that just simply don't report, which is not good when you're encouraging tax evasion, in my view.
Yeah.
So in any event.
So critical there. Again, for our listeners, what we take from that is know where you're trying to set up these businesses.
Yes.
So that you can be as profitable as possible.
Yeah.
So that you can avoid this instance where if you're buying in those areas and you either create tax evasion or you create a lost economic opportunity by having to report by not being able to claim your expenses and in turn paying tax on your gross income, not net.
Yeah, absolutely. I think that what I hope to do, though, when I talk about this issue and I try to educate people about this, is I want people to be upset by this law, right? Because to me,
rather than conform,
right.
That's how we change it.
Right. They should be speaking up. I'm not, I don't want them to be upset to not report their income. That would be unethical and frankly criminal of me to encourage that behavior. And I never, ever would do that.
Mm-hmm.
Instead, what I want people to do is speak up. Once they understand the devastating and silliness of this policy and the dangerous of this policy, what's next? Are they going to start denying expense deductions against real estate professionals?
Right.
Or bakers?
Mm-hmm.
Pick your poison. What boogeyman is going to be next out there?
Yeah.
And do you have any tactical steps for everyday real estate investors who are doing Airbnb for them to essentially speak up in effective ways?
What is the most efficient and effective? Speak up, great to say.
Yeah.
How do we do this?
Well, hey, I started off in my career. You guys had a kind introduction to me. I didn't get there by not speaking up, right? Or I started picking up and writing things. It was dangerous for me, and dangerous not the right word. I was nervous to do it.
Right.
Now I just don't give a shit in the whole scheme of things. Because I've got lots of years of speaking up, I don't really care. As long as I'm confident in my subject matter, which 9.99 times out of 10 I am, then I don't care about the criticism. I want to hear other alternate points of view. But to answer your question more specifically, what can your listeners do? Well, write, letters to the editor, for example. That's an easy thing to do.
Yeah.
Write letters to your MPs. Better yet, go talk to your MPs. Go talk to your MLAs. Have them explain the logic of the policies that they're doing. A lot of these ideas that are put forward as laws are driven by bureaucrats who want their agendas put forward, or grassroots stuff that in many cases just makes no sense.
Right.
So meetings with MLAs, MPs can have some significant impact. As much as some people think it's a waste of time, I think it's pretty effective.
Speak up.
Speak
Educate
up.
yourself.
Yep.
Educate those around you.
Totally.
Right? Like these dinner table talks are of value.
For sure.
And if you can have a reasonable discussion, maybe you can convince somebody of what you believe in.
Well,
and what's true in terms of facts.
Yep. I try to educate my kids all the time around the dinner table. I mean, my kids are now older and don't have the dinner time talks as much as except through group chats. And my kids get a little tired of my educating talks, but at the same time, it's been, I think pretty effective as parents to do that. So anyway.
Cool. Moving on from short-term rentals, let's talk about capital gains. We'll put a little bit of guardrails on it as it relates to real estate.
Okay.
As it relates to what these changes are going to mean for real estate investors, for homeowners, for secondary, for people who own multiple houses, multiple pieces of real estate. I think the principal res piece should come into that conversation, but I'll leave
Sure.
that with you.
Happy to talk about that. Actually, the principal residence exemption maybe is better when we talk about through the flipping tax.
Sure.
But
Sure.
You want me to dive into this change proposed?
Yeah, let's dive into the change. Let's dive into what your clients are doing again, I know we're going to get back to how do we create change, which is through education.
Yeah.
But also, how do we manage through this change, which a lot of Canadians are wondering. And not all Canadians, unfortunately, have access to amazing advisors. Yeah.
And that is certainly true that a lot of people can't afford good advice, right? But so just a quick review. Most of your listeners probably already know this, but for individuals starting June 25th forward of 2024, the capital gains inclusion rate goes from 50% to 2/3. And for corporations and trusts, it goes to 2/3 as well. But the difference is that individuals will still get $250,000 of annual capital gains at the 50% inclusion rate, whereas corporations and trusts do not.
Essentially, it stays the same. They're exempt for the first $250,000. Thereafter, it increases for individuals.
Yes.
Yeah.
But for corporations and trusts, the first dollar of capital gains is at the higher inclusion rate. So the alarm bell should be going off for a lot of people right away, because for corporations and trusts, especially the audience that you deal with, real estate investors, and there's, I'm going to guess, a significant chunk of them, especially if they're acquiring and then flipping, or they're renting and putting in pools.
Mm-hmm.
A lot of it's probably held by corporations.
Yeah, most are operating in corps.
Yeah.
But that flipping activity, like that buying, renovating, selling, they're deeming that as business income.
Well, that's different.
Okay,
that's different. We'll get to that when we talk about flipping tax.
Perfect.
But assuming it's a buy and hold strategy, which typically is going to be capital gains results, not for developers though, of course, because anytime you buy and sell as a developer, that'll be business profits.
So this piece that we're about to get into is more for our BRRRR clients. We call these people buy, renovate, rent, refinance, repeat. So they'll use our money short term. They'll build rental portfolios. They'll hold those for 5, 10, 20.
Yeah, those would be capital.
And these are people creating units.
Yeah.
These are people that are solving the housing
So
problem.
they're not boogeymen.
I don't think so. I don't think any of our clients are boogeymen. But they've been treated like that. So anyhow.
Well, certainly. The buy and hold gang that you're dealing with there, that crowd, it would more than likely be capital gains when they refinance or try that again, when they sell.
When they dispose, yeah.
Yeah, especially if it's long-term holds. And especially if they're acquiring for rentals. And so the issue there is if it's through corps and they eventually do sell, then it's at a 2/3 rate. Mm-hmm. Now, when you run the mathematics on that and compare that to individuals, the system is not integrated anymore. one of the foundational policies in Canada from a tax policy perspective is that our tax system should be integrated. And in plain English, that means that whether I as an individual invest money, let's say it's $1 million, and I buy a rental property, versus I put the $1 million inside my company and buy the rental property and earn the rental income, the flow through tax on the eventual rental income in my personal hands versus the flow through tax inside the company on that rental income, taxing the rental income and then distributing it as a dividend.
Mm-hmm.
The total tax on the corporate side, add the corporate tax and then add the personal tax and the dividends when you strip it out, should be the same as if I had earned it personally.
That's the goal.
That's the goal in Canada, is integration. That's what we call integration. And for the most part, it's pretty close across Canada. Whether you place your investment dollars in a company or place your investment dollars personally and realize profits, including capital gains down the road, the system is pretty integrated. It's not perfect, but it's close.
Right.
Now, with the introduction of a threshold just for individuals, 250, versus no threshold for corps and trusts, well, now integration's out the window, right? You're always going to want to place your investment dollars personally, but that clashes with creditor protection, for example, objectives, right?
Yeah.
Who in their right mind as an investor is going to want to place their investment dollars when you get no creditor protection that you would otherwise get through a corp?
Mm-hmm.
And so this really is a public policy clash, if you want to call it that, in addition to disintegration on the tax side. So that's about as technical as I'm going to get.
Yeah. I think that's perfectly technical.
But where this is going is that longer term, you're going to be faced with situations with your clients where if they're getting good tax advice, assuming that there's no changes to the proposals, that they will be motivated to invest personally as opposed to corporately. And that's, in my view, not good.
Yeah, as you're walking through this, I just think of the complexities to model it out all the way.
It's crazy,
right? And how much guys like you are going to benefit from this.
You know what?
Not really. Is that fair to say?
No. I mean, and I get that kind of crap all the time. Sorry, Jesse.
Yeah, I like it. I love it. Correct me.
I even have some finance bureaucrats who say, "Hey, Kim, you and your firm are really going to benefit from these changes."
Right.
And my easy rebuttal to that is, you know what? We're already busy. Like there is a massive shortage of tax professionals in Canada, and I mean massive.
For more billables.
I'm not looking for more work.
Yeah.
It's kind of like the doctor. Are they looking for more patients? No,
right.
They're not.
Yeah.
There's a shortage of doctors. There's a shortage of tax professionals, and frankly, there's a shortage of accountants.
Particularly solid advice.
Yeah,
like sound tax.
You know what this is going to do, unfortunately, is it's going to drive up the cost of getting advice more because the average public is going to now need more people like me and at a specialist level. And what does that do? It drives demand.
Yeah.
And if you've taken any basic economics course, you know that supply and demand, right?
We just talked about on the housing problem. The
right.
reason why we're paying so much for houses is predominantly around the supply and demand strip.
Yeah. And so my hourly rate is already outrageous.
Yep.
Do you think it's going to become more outrageous? Of course it is.
Yeah.
Because I only have so many hours in the day.
Yep.
And so from that perspective, I always push back. So don't ever say that again, Jesse, because I'll tear you apart.
I love bringing that up with my lawyer, with my tax account, all my buddies who are in that type of professional services.
They just love you for it. I'm sure they beat the shit out of you for it too. But in any event, I lost my train of thought. So what were we talking about?
We were talking about cap gains.
Yeah.
As it relates
to the changes,
the new status, and the changes and the implications of that.
Right. So let's talk about what you're...
And essentially, the implications of that are for our real estate investors, the decision-making process as to how you hold it is going to differ now.
It is. And so that's implication number one, is because the system now is disintegrated, you're going to be motivated to hold it personally. So that, in my view, is wrong.
Yeah. Your cost-benefit analysis, your running of your pro forma of your modeling
it's
is going to include this big decision.
Correct. Yep. Number two, to get to the heart of what you introduced this topic on, what should your audience do if they, as a result of this change? That's something that we're struggling a little bit with as a profession, because they introduced this proposal on April 16th with no draft legislation. And so there's no details out there. And as I loosely understand it, because we've made phone calls to the Department of Finance, the bureaucrat level, and we've asked, we've asked specific technical questions, because there's a lot of technical questions here, right? And they said, listen, we don't know yet. We're still working on the draft legislation.
Okay.
And from what I loosely understand, they're not even close to releasing the draft legislation. So worst case scenario, we could be approaching June the 25th with no draft legislation. That would be worst case scenario.
So zero guidance. Other than what has been released, which is
pretty bare bones
for interpretation.
Correct. And so the obvious question we get a lot of right now is, should we be monetizing and crystallizing our capital gains to avoid the 2/3 inclusion rate after June the 25th?
Right.
And
that's something we're following. We're here because we're worried about, like, from a valuation perspective, all of a sudden a glut of inventory, talked about supply and demand, bringing down prices, could be an excellent opportunity to buy. We're not seeing it in Calgary.
No.
We're seeing some stuff in GTA and specifically Cottage Country.
Yeah.
Where likely that's happening, but it's not in a major way where you're seeing people try to sell in front of the 25th deadline.
Yeah, and first of all, with respect to real estate, that's a tough thing to do.
It's not liquid.
Right. Now, you can manufacture the disposition by transferring it to corporations or to a partnership, and there's things like that you can do without actually liquidating or selling.
Right.
And so that's some of the things we're doing. But I think the real issue, to answer your question broadly, what should your clients do pre-June 25th? I think for individuals who have very low pregnant gains, unrealized gains, probably not a lot to do there, would be my guess. For corporations, though, and trusts, it's rarer that they hold real estate, so I won't focus on that too much. But corporations, very common. And should they be looking at potentially crystallizing? Yes, you should be. You should be running the mathematics.
Mm-hmm.
But in my view, it's really not about trying to accelerate the tax, even though the government wants you to accelerate the tax, which I'll come back and talk to you about that.
Let's talk about that, how they modeled it out, where it's one bump and then negligible thereafter.
Okay, well, I'll take it. Yeah, I'll digress for 2 seconds and I'll come back to my thought here. But because I put something out on my LinkedIn account on that. But you guys follow me on LinkedIn?
I do, and our listeners should follow you because
I'm a bit of a mouthpiece.
He's even more unfiltered than and what I also love is your willingness to give the facts and prove it out.
Yeah,
it's
and
not conjecture.
Yeah, to me, I mean, which I certainly do have my opinions, and I'll slam the government when I feel I need to, but I like to think my comments are fact based, and in this case, to what you're saying, the government has actually projected and has, in a nutshell, they want to encourage Canadians, especially corporations, to monetize their gains, to crystallize their gains pre-June 25th.
Yep.
And right in their budget projections, they're estimating that there'll be, and I'm rounding up here, it's 4.6, I think, in 4.6 billion. So rounding up, let's call that $5 billion. And and if you look at the next year, what they're projecting to raise as a result of this capital gains inclusion rate, it dramatically decreases to, I can't remember the number off the top of my head. It's somewhere around 1.6 billion.
Yeah, I think it's like a quarter thereafter.
Yeah, and
so
then
help with the current deficit, but the budget deficit.
Yeah.
But then what?
Yeah, then it declines. And then if you go to the second year after, it actually is a loss for them. And I thought, what the hell? Oh, I get it. So people are going to start liquidating a couple of years from now, and the values are likely going to be lower. And so there'll be some capital losses. Oh, I get it. And so it's going to cost the government some money. And it's right in their projections. And so what I get really upset with is...
They're almost like these pubcos where they're just front running.
Well, yeah.
Front running their balance sheet.
On the backs of Canadians.
On the backs of Canadians.
Right? And so you're encouraging to monetize. In the meantime, they've kept their deficits less than 40 billion or less, which is a bunch of crap because they're projecting 5 billion to raise on this measure alone, plus on the individual side another I'll call it 6 billion. So call that 6.6 billion that they're projecting to raise as a result of accelerated tax.
Mm-hmm.
And so that to me is just very deceptive and very manipulative. Manipulative is probably the better word rather than deceptive. But so let me circle back to what I was starting to say here. I wrote a piece on this in the Financial Post 2 weeks ago now. And notwithstanding, I love the study of tax and taxation policy and keeping up to date. Tax is not the most important topic there is. It's probably one of the most difficult things in the world. It's way more difficult. Albert Einstein said there's nothing more difficult than the income tax. And I think he's right. It's way more difficult in medicine and physics and astrophysics. But it's not more important. And the mantra I use all the time, and I've been saying it for 30 years because I learned it from some of my mentors, is tax should not wag the tail of the investment dog.
Yes.
Right?
Yeah.
So think about that for a second. You got the government that's encouraging the tax to wag the investment dog.
Mm-hmm.
So I think what needs to happen is people need to come to people like you and say, hold on a second. Should we be crystallizing here? Well, from an investment perspective, does it make sense? What's our payback period? Like what's our, and when you run some simple models, like we ran some models, trying to remember the scenario. I think it's $1 million capital gain with the projected 6% rate of return. And the payback period would be, I think it was 7 years, something like that.
Mm-hmm.
Well, that's a long time, right? That's a significant percentage of a person's lifetime on a payback period or break-even point, I mean. And so it's analysis like that need to happen, right? Rather than just, I got to race to June, before June 25th to trigger some gains. I would say in some cases, yes, it does make sense.
Yeah, there's going to be some easy no-brainers.
Right. But I would suggest in a lot of cases, it's going to be a lot more complicated to make that determination. And it will involve a lot of complex modeling in terms of what's the payback period.
Mm-hmm. And net, in terms of the behavior that will occur, how much are we disincentivizing these type of activities through this tax?
Well, that gets to a broader question in terms of, is the increase going to help or hurt Canada from an incentive point of view, like encouraging investment, encouraging risk takers?
Yeah.
And I think the answer is obvious, right? I mean,
which is where I think we have the problem, which is we're not incentivizing.
You're not incentivizing
people that
risk.
are going to create productivity and create a tax base and build this country.
Let me. Do I have 5 minutes to digress into this a little bit?
I think so. You're the one that needs to leave in 20 minutes. So yes, we definitely want to make time for flip tax and principal res.
Yeah, that's easy.
We've talked about these people that are owning long-term and the decisions we need to make there.
Yeah.
But let's go 5 minutes.
Okay. So let me test you a little bit. Were capital gains always taxable in Canada? Yes or no?
Always?
Yeah. We've had an income tax in Canada since September of 1917.
I'm going to guess no.
Okay. You guessed right. When did it become taxable is the next question. Because Canada chose
after the Second World War.
You're right, but let's be a little more precise. Because the World War ended in 1945, so you weren't even born then.
I'm going to guess. What would a major economic event or budgetary event have happened?
Okay, you're chewing into my 5 minutes.
1955.
Fast forward 17 years. So 1972. January 1, 1972, which was the culmination of the most major tax reform we've ever had in Canada, was January of 1972.
Okay.
Now that, prior to January of 72, capital gains in Canada were not taxable. And there was a deliberate policy choice there because they wanted to encourage entrepreneurship, they wanted to encourage risk-taking, what have you. And there was other countries around the world that weren't taxing capital gains. But John Diefenbaker back in 1962, who was our was prime minister then, took a really ballsy move, and he called he commissioned the Royal Commission on Taxation. And he was pretty open-ended, and he basically asked for this panel led by Kenneth Carter, who's a CA, to look at Canada's tax system and make recommendations in terms of what we could do better as a country. And it was, like I said, it was pretty ballsy. So one of the recommendations that came out of this commission, because the report was released in 1966, 4 years later. Okay. So it was pretty ballsy because it took a long time, right? And one of the famous quotes that came out of that commission is, capital gains should be taxable. And it was along the logic of a buck is a buck is a buck. In other words, if you earn $1 by way of capital gains or by way of salary or by way of dividends or interest income, it's a buck.
Right.
And therefore it should be taxed. That was his basic premise. Now the lefties have taken that very literally, even to today. And you'll see that in the literature, even with respect to this capital gains inclusion rate stuff. Mm-hmm. A buck is a buck. It's all about equity. But the politicians back in the day did not accept at its extreme literalness, a buck is a buck is a buck, because they recognize that the character is different. The behavior to earn a dividend is different than salary. There's much more effort that's put into salary than there is to earn passive income.
Sure.
There's much more effort typically to earn capital gains in many cases. Sometimes it's just buy and hold, but it takes a lot of risk, right? And that risk may be time. It may be effort. It may be,
capital outlay.
And that's the key issue is risk, right?
Yeah.
And so the policymakers at the time did not accept that capital gains should be fully taxable because they want to encourage that risk taking. Mm-hmm. And so they compromised, and with some pretty rough justice, with not a lot of science behind it and some data, they just said, you know what, fine, capital gains are going to be taxable, but it's only going to be half taxable because we want to encourage entrepreneurship. And that's literally how capital gains came to be taxable in Canada. Fast forward to today, and that's the problem with the capital gains inclusion rate, is you have all this messaging from the government that it's targeted to the rich, which first of all is bullshit. They said 0.13%. That's crap. That is deceptive, and it's manipulative, and it's garbage statistic. Because anytime you increase the capital gains inclusion rate, it's going to impact everybody, every Canadian, especially pension holders. Companies that realize capital gains and pay dividends, now there's less dividends to pay because they're paying more corporate tax. Mm-hmm. Very simple analogy.
And we're all pension holders.
We're all pension holders.
Another, regardless if it's in the, call it classical sense, it's through the employer, but CPP.
Yeah, CPP. Absolutely. So even that simple analysis there. So fast forward to these academics who are arguing a buck is a buck is a buck, and it's all about equity and capital gains should be fully taxable. I think they need to understand context and history and the value of risk. Risk taking is something that should be rewarded because most human beings are not wired to accept risk. There's a reason why we have fight and flight instincts, right?
Not too many people are willing to sign the front of the check.
Exactly.
Everybody's willing to sign the back.
Right. But do we need risk takers? We need them to survive. Clearly. We need small businesses. We need property investors and real estate investors and people that support them, like you guys. We need them as a society to be successful, to improve our productivity issues. And what is this going to do? It's going to disincentivize risk. And I worry about that as a country. So there's my long-winded 5-minute digression.
Well, thank you. I think we all learned a lot. I should have known 72 because I read your article about that. Should we call it a tax reform, for lack of a better term?
Yeah.
And it was from your standpoint.
It was very comprehensive.
Yes. One of the best ever.
It was the best and the only ever.
Right.
We've had very limited reviews and changes since that time.
Have many other, and now I'm wasting our time, many other Western countries, let's call them business forward, done a similar review and analysis? And like is there a parallel in Britain, in the US?
The short answer is yes. Actually, I had the pleasure of having dinner with the former Prime Minister of Australia here about a month ago, and I asked him that question. I said, I was reading coincidentally about tax reform. And so we got into a long discussion over dinner about Australian tax reform. And the short answer is, yeah, they've had a couple actually in the last dozen years. UK has had some. US actually had a significant one during Trump's, which actually surprised me that he was able to get that passed, but in 2017. And so the short answer is yes. Now, in my view, I'm a purist when it comes to tax reform. I think we should have another Carter Commission, another 4 years, try to take politics out of it. Unfortunately, there's just no way that the political environment will allow for that. It's too risky I don't care if you're the Liberals.
The timeline is too long.
It's too long. And if you don't come in, if the government, whoever it is that commissions this, wants to know at the end of the day, what's going to be the end result here.
And is politics is too partisan now, isn't it? How could you say, how could Poilievre or Trudeau or Trump or Biden do this and have 50% of, right off the bat, you're going to have 50% of the people saying no way.
Yeah. And it's, it could be an absolute disaster if you could have a report that's issued that completely goes against all the political policies of the government of the day, right? It's way too risky today. And so what I see happening is some sort of limited reform panel happening. Maybe they got a year, and this is the things they're going to study: productivity, what's our personal tax rates, what's our corporate tax, what about GST? There'll be a very short list,
clear mandate that is bipartisan,
and it will be nudge, nudge. This is what we want.
So, yes.
So
okay,
that's my guess.
Yes. Thank you, Kim. Let's talk about. So we talked about cap gains. We talked about short-term rentals. A lot of our clients are buying, renovating, and selling.
Yeah, flipping.
A lot of times.
Which that phrase bugs me, but anyway.
It bugs me too. Really what they're doing is they're taking the way I see it, my very biased perception of it, is they're looking for underutilized housing stock. They're identifying it. They're buying it. They're putting significant improvements into it to make it more habitable. And in a lot of instances, adding units, basement suites.
Yep.
They are a big boogeyman.
Oh, completely. Because apparently...
Let's talk about tax as it relates to them.
Sure. Yeah, they're a boogeyman because apparently they're getting all these houses. They're taking away the market and they're profiting from it because they're flipping them. Like, how silly.
These guys are grinding it out more than any entrepreneur I've seen. Anyhow.
To me, that's just a radical left-wing ideology that makes no sense. Because if anything, they're adding, they're adding to the housing.
It's additive.
And yeah, additive. That's a good phrase. And God forbid they make some money. And so I don't know when making money became such a bad thing in our society. But that issue aside, federally, in the 2021 federal election platforms that came out with each of the parties, the Liberals in their infinite wisdom had 2 sentences. And I remember reading it because I was in a hotel in Vancouver, and I read these 2 lines, and it said that if they get elected, they're going to introduce an anti-flipping tax. And I thought, all right, I wonder who wrote this.
Yeah.
Because number one, they don't understand tax. Because we already have an anti-flipping tax in the Income Tax Act. And let me give you an example.
Isn't it called capital gains?
Well, no, not necessarily. The phrase I'm talking about is, I don't know if you ever heard of adventure concerning the nature of trade. You ever heard of that? No. So here's kind of the basic concept. If you buy a property and with the intention of flipping it, I'll use that phrase, even though I hate it. And your intention is to not buy and hold.
Right.
Instead, you're just going to, put some lipstick on the pig and then sell it.
Yeah, you're going to identify an opportunity. You're going to add some value.
Yeah.
And create a better product.
Yep. That is not any profits that are generated from the silly examples. And I'll give you a story here in a second. Those profits are considered business profits. They are not considered capital gains.
Yes.
So let me tell you a story, which ties into the flipping tax. So this is true life. So my uncle in the 1980s, I think you were around.
I was born in 81.
81. Holy
Yeah.
shit! So I'm way older than you are.
Yeah, yeah.
So,
There's been something wrong with me.
My skincare.
so and you're way
I'll get
younger.
my wife on that.
I'm sure you've heard of the National Energy Program back in
Yes.
the early 80s.
Yes.
You were a youngster then.
We were around. Our company was around, and our company was impacted significantly because we were only operating as a housing lender in Alberta.
Yeah, then you would have been really impacted negatively,
Yes.
right? So,
Yeah.
and of course, so what was happening back then is, especially in Alberta, housing prices went down. People were handing the keys over to their lenders, et cetera, et cetera.
No recourse in Alberta, so
Right.
it's easy to hand the keys over.
And so fast forward a few years later, and the National Energy Program was gone. There's still a lot of devastation, but of course, the real estate market is starting to pick up,
Mhm.
right? And values are increasing. So my uncle, thinking he's a tax expert, living in central Alberta, and the economy's starting to get a little bit better and prices are increasing, he sees an opportunity. And he thinks that, to claim the principal residence exemption, all you have to do is live in the house, for a day, because that's the mythology, right? You live in it for a day and then you sell it and you claim the principal residence exemption.
You're literally living there. You can prove it.
Yeah,
Claim
that's
the exemption.
That's the mythology, yes. And I'll put some I'll poke the stake in the heart on that one in a minute.
Okay.
So he started buying properties. At the time, he was married, still is, to my lovely aunt. Had 3 young kids, my cousins, and he starts buying, and they move in, and then they sell very quickly. Make some money, buy another house, move in. And, he did this 11 times in the span of roughly 3 years. And I'm exaggerating a little bit, but it's a very short period of time.
Right.
I think it was in the
Month
neighborhood.
or 2 at a time.
Yep. It was 11 times, made a ton of money, and never reported a dime of those profits, because at the time, if you're claiming the principal residence exemption, the CRA had this policy that you didn't have to report it, even though in the Income Tax Act.
Well, you didn't have to tell them that you
No.
did this.
No.
Okay.
Fast forward to 2016, and they finally changed that silly rule. And now, if you claim the principal residence exemption, you have to disclose it on your tax return.
Yep.
Which makes sense to me. It should have been that way forever, because they would have caught my uncle years and years ago,
Yeah.
right? But here's the challenge with that. When he bought those properties, each one of them, he had no intention of staying in those properties. He just wanted to live in them,
Right.
flip them.
Right.
Yeah.
And one of the key components of having a property and claiming the principal residence exemption is it must be what's referred to as a capital property. It cannot be a property that is inventory. So I always use the analogy of a book on a shelf. If you're a bookstore owner and you have a book on the shelf, that's inventory.
Yep.
Right? A real estate developer, well, it's the houses they have for sale.
Yep.
Or the lots that they have for sale. Well, my uncle was exactly the same. He was he was in the business of flipping houses, and in that case, each house was his inventory. It did not meet the definition of a capital property, and so for all these people out there that are like my uncle and buy condos, and they quit claim or just transfer the property over before they even take possession.
Yeah.
That's more than likely business profits,
Yes.
right? And instead of capital gains. But you have all these people that think that when you buy a property and flip it, like my uncle, that's capital gains at a minimum, and in the best case, because you've lived in it for a day, which the legal phrase, you have to ordinarily inhabit the property. And ordinarily inhabit.
That definition is critical.
Yes, and it doesn't mean a day.
Right. Right.
It's much more broad than that. And so my uncle was misinformed, made lots of money flipping properties. So this law has been on the books ever since 1972.
It's always been there.
It's always been there.
Yeah.
So let's go to January of 23 now.
And the release of this anti-flipping tax.
Right. So the rule is that if you're like my uncle and you buy a house, residential property, and you live in it for less than 365 days, any profits are now considered fully taxable. They're not capital gains.
Right.
Unless you have so-called life exceptions, which is just silliness. So if you die, or if you're by way of reason of marriage or divorce, you have to sell the property. Or I like
I
this
think
one.
financial hardship they use.
Financial
like, lose your
hardship, yeah.
job.
I love this one though. Threat of personal safety. So let's say you and I are neighbors,
Yeah.
and let's say I don't shovel my walk, and so you come to me and say, Moody, you better shovel your damn walk, and if you don't, I'm going to kill you. And I
Right.
say, oh, I'm selling my house. Like, how do I prove that?
Yeah.
Right? This stuff.
It's an easy loop.
Hey neighbor, send me a threatening letter.
Yeah, this stuff gets really silly, right? The life exceptions. But now you have this overriding law that complicates the existing law, because the existing law has teeth. They just need to audit it if they're concerned about it. And now they have the disclosure, because every time, really what they're after is principal residence exemptions. That's the main thing they're after, like my uncle.
Yeah. They tax avoidance.
Yeah.
Avoidance through this principal resident exemptions, which our borrowers are not doing.
Exactly. So they're after that. That was the primary thing, because they think that people were abusing the principal resident, and there's no doubt. But I think a lot of that's an audit.
Yeah.
And then secondly, what they're after is people that report capital gains instead of profits. But again, they have the tools to review that, which they should. So what they did instead is made their lives easier. At least they think it's easier. But they, being the CRA and finance, and introduced this arbitrary 365-day rule where it's automatically fully taxable unless you happen to meet these life exceptions. Fast forward to BC.
Right. So they just took it this from the federal perspective.
Yes.
They took it a step further.
Yeah.
By thinking they're giving guidance, by saying it has to be this 365. So not only do we already have the rules in place, yes, there's interpretation. Yes, it's anything with interpretation is tricky.
Yeah.
But they've taken a step further and saying plus 365 days. That's the only change, essentially.
Effectively, yeah.
Okay.
But it's a little more complex than that. But yep, effectively.
Okay.
But what do you think in behavior that's going to do? So let's say I have a property I bought and I do want to sell it. Am I going to sell it? On what day am I going to sell it?
Right.
365 or 366?
Yeah.
I'll sell it on 366. And I'm going to be thinking that that's safe. But is it? No. Because under the normal rules...
You still have the underwriting original rules.
Exactly.
Right.
And so this is going to really complicate and put false hope into people, that thinking that if they get past that 365 days, that they're home free and it's capital gain. Right. No, sorry. You still have the general rules that apply.
And the rules were already more than sufficient? Is that what
I'd say they were more than sufficient. And they've been around since 1972, when capital gains became taxable.
Yeah.
They just didn't simply audit enough, especially in the principal residence, because they never required disclosure, like my uncle.
Yeah.
Yeah, I mean, I love my uncle to death, but he got away with
tax avoidance.
He got away with a lot of tax-free money.
Okay, now so we're going into BC.
So BC, in its infinite wisdom, decided to follow the same ideology as the feds, but in their infinite wisdom, they thought they had to do one better. You know, instead of 365, they're going to make it 720, which is 2 years. But they're going to follow the feds on 365, so it'll be fully taxable up to 365, but then it'll prorate down for the next 365. So if you sell on day 600, for example, then you'll have to do the math and prorate the amount down in terms of how much is fully taxable.
Yeah, but haven't they also increased the tax burden within that?
No, they've increased the tax burden. It's not going to be a capital gain. It'll be fully taxible for BC purposes.
As normal business income.
Okay,
because going back to my NIMBYism, being a business owner who supports real estate investors, are they building something that's going to completely disincentivize our hardworking entrepreneurs to buy these utilized properties, put good money into them, put their expertise into them, and sell them?
I think absolutely it's going to, right? Are BC property owners now going to be, and it doesn't matter where you're located. Like, let's say you have an Ontario company, an Ontario business that wants to buy BC real estate and then flip it.
Yep.
Well, now to avoid this BC tax, they're going to have to hold the property for 721 days to avoid it.
To avoid the tax. But in terms of business as usual, I was operating in BC, paying business tax.
Yep.
On the houses that I'm buying, renovating, and selling.
Yep.
Today.
Mm-hmm.
new tax regime comes into play,
Yep.
what is the impact to me?
Well, I think I've already answered that, but just to repeat myself, if it's a buy and hold, like let's say you're buying and holding properties.
I'm buying and selling.
Okay, if you're buying and selling, then more than likely there's not a lot of impact, right? Because more than likely your profits are business profits and not capital gains. Right.
Okay.
So whether they deem that to be a flipping tax or what have you, who cares? It's just fully taxable both for BC purposes and for federal purposes.
Okay.
So if you're a property developer, that's buying and selling, then likely very little impact because your profits are fully taxable.
Okay.
Where this really gets and hurts people is the buy and hold.
Yeah,
right?
the people that are creating rental stock.
Yes, because the properties that they're acquiring are capital properties. If they would normally sell them, it would be a capital gain. But for this new rule now, for BC purposes, the capital gain won't be a capital gain. It will be, at least for BC purposes, if you sell anywhere between 366 days and 720 days, it'll be fully taxable for BC purposes. Now, again, it prorates down to zero on the 720th day.
Yes.
But at the end of it's just, these are left-leaning ideological wannabes who are thinking too hard.
Right.
This will disincentivize property ownership in BC, in my view.
And complicate
taxation.
Yep. Which is already...
It's already too complicated.
The most complicated subject on earth.
I think so, yeah. So it's ridiculous.
Yeah, it is. So amazing. I don't think we need to take up any more of your time. I do want to highlight that I need to better understand the implications of the BC as it relates to flippers. Might have to spend some of our hard-earned money with Kim, or maybe I can convince him to co-author something with us. But regardless, thank you so much for joining us, Kim.
Yeah, pleasure.
Again, going back to the insights that I think you provide to your clients, but also to the public. How do people get a hold of you?
Well, they can find me a number of different places at my firm at Moody's Tax or Moody's Private Client. You just Google that, you'll find me. I also have a personal website, which I do a lot of my passion projects on because I do a lot of writing and speaking and videos and just on tax topics and leadership topics and economics. I love the study of leadership, so I do some stuff there as well at kimgcmoody.com. There, you find me on LinkedIn.
He's a good LinkedIn follow.
I'm a bit of a mouthpiece there. And then I've been experimenting more with Twitter as well. I certainly don't have as much coverage there as I do on LinkedIn, but it's at kimgcmoody.
If you keep opining, you'll get the coverage.
Yeah. So
awesome.
All right. Thanks very much, guys.
Yeah, appreciate it.
That wraps up another episode of the Real Estate and Wealth Podcast. Be sure to hit that like button, share with fellow real estate enthusiasts, and subscribe to stay in the loop on all upcoming episodes. Get in touch with the team at Calvert Home Mortgage Investment Corporation by calling them at 1-888-752-4642 or email admin@chmic.ca. The opinions expressed in each episode belong to the individuals featured and do not represent the views of Calvert Home Mortgage. While we provide valuable insights, consulting with qualified professionals ensures that your unique financial circumstances are carefully considered, aligning your investments with your long-term objectives. Calvert Home Mortgage Investment Corporation is not a financial advisor, and we cannot advise you on making investments. There are risks to investing in real estate and the potential that you can lose all of your investment.